Hello everyone. Today we starting the lecture number 23 that is all about the Export Credit and Guarantee Corporation. After this lecture you will be able to understand what is all about the Export Credit Corporation, Credit Guarantee Corporation of India Limited. As we know, it was establishment year is in 1957 by the government of India. It's totally central government body, totally central government organization. So Export Credit Guarantee Corporation of India Limited was established in the year 1957 by the central government of India. The Export Credit Guarantee Corporation of India Limited is company wholly owned by the government of India based in Mumbai. So head office in, where is the head office? Head office in Mumbai, Maharashtra. Okay. It provides export credit insurance support to Indian export and is controlled by the Ministry of Commerce. It is basically working for to providing certain insurance support, because as we know, whenever we are doing international business, there are numerous number of risks involved in an international business. It might have some certain damages risk, it might have non-payment of the importer, so it can be the numerous number of the risks are involved in an international business. So Export Credit Guarantee Corporation plays a very vital role. So they are providing certain insurance support to the Indian exporters and is controlled by the Ministry of Commerce. If we will talking about how the evaluations of ECG, the need for export promotion had started immediately after the independence in the 1947. As you know, after 1947, and we have started certain export and import businesses from India to across the globe. So since 1947, we had requires a need of evaluation of the ECG. So during that time, during the Krishnamchari, finance minister in a Pandit Nehru cabinet, appointed a special committee under the chairmanship of Sri T.C. Kapoor to examine the feasibility of setting up an effective organizations to provide insurance against export credit risk. So in a very early stage of the independence, we have started working for setup of ECG, because as per the recommendation of the Kapoor committee, the Export Risk Insurance Corporation (ERIC) was registered on 30th July 1957 in Mumbai as a private limited company, entirely state owned under the Companies Act. But after that, what happened? It has been converted in a ECG. So as per the recommendation of Kapoor committee, because Kapoor used to be the TC Kapoor used to be the chairman, and he was appointed to examine the feasibility of setting up an effective organizations to provide insurance against export credit risk. That is the thing. We have taken the recommendation of the Kapoor committee, and thus the Export Risk Insurance Corporation (ERIC) was registered on 30th July 1957 in Mumbai as a private limited company, entirely state-owned under the Companies Act 1956. If we will talk about the vision and mission of the ECG, so yeah, ECGC we can call the vision of Export Credit Guarantee Corporation of India Limited is to excel in providing export credit insurance and trade related services. They are basically working for providing certain export credit insurance to the exporters, and apart from this insurance, they are providing numerous number of other trade related services also to the Indian exporters. The mission of ECGC is to support the Indian ECGC stand for Export Credit Guarantee Corporation, is to support the Indian export industry by providing cost-effective insurance and trade-related services to meet the growing needs of Indian export market by optimal utilization of available resources. As we know, the basic mission of ECGC is to support the Indian export industry by providing the cost-effective insurance. Because if suppose that we were taking any private companies to secure our product and services, their premium was very much high, which is not in the favor of exporter. That is the thing. The mission of ECGC's Export Credit Guarantee Corporation to support the Indian export industry by providing the cost-effective insurance and trade-related services to meet the growing needs of Indian export market by optimal utilization of available resources. That is all about the vision and mission of the Export Credit Guarantee Corporation. Okay. Further, we are moving towards what is all about the exchange control declaration form. Under the Custom Act, every exporter is required to declare export value of shipment and give an undertaking that the export proceeds would be realized within a period of 6 months from the date of shipment or due date, whichever is earlier. So under the Custom Act, every exporter is requires to declare the export value of the shipment. Every exporter has to require the declare of the value of the shipment and given undertaking that the export proceeds would be realized within a period of 6 months from the date of shipment or due date, whichever is earlier. If the custom clearance for the shipment is made manually, declaration is made in the GR form in duplicate. Okay, so if custom clearance for the shipment is made manually, declaration is made in GRR form in duplicate. If the clearance is computerized, SGF form in duplicate is used in the place of GR form. Okay. Yeah. Okay, so GR is stand for the what we call guaranteed remittance, and SGF statutory declaration. Okay, form in a duplicate used in the place of GR. If the clearance is computerized, in the case of the in the case of manual, then GR form will be used, but in the case of the computerized, SGF form will be used in duplicate used in the place of GR form. During the Sri Morarji Desai's Union Commerce Minister inaugurated the ERIC, and the first policy was issued on 14th October 1957. Sri Morarji Desai used to be the Union Commerce Minister, inaugurated the ERIC, but the first policy was issued on 14th October 1957. Sri Ratilal M. Gandhi, RM Gandhi was the first chairman, and Sri T.C. Kapoor was the first managing director of the corporation. He used to be the chairman of that particular committee who have getted the information about the feasibility of EPCG. So Sri Ratilal M. Gandhi or RM Gandhi was the very first chairman, or T.C. Kapoor was the first managing director of the corporation. Right? Okay. After introduction of insurance cover to bank during the periods 1960-64, the ERIC name was changed to the Export Credit and Guarantee Corporation Limited in 1964. Clear? So I've been already told you ERIC has been changed to the Export Credit and Guarantee Corporation Limited in 1964. So after introduction of insurance cover to the bank during the periods of 1960-64, ERIC name was changed to Export Credit Guarantee Corporation Limited in 1964. To bring Indian identify in the name, ECGC was renamed as Export Credit Guarantee Corporation of India Limited in the year 1983. Clear? Further, what is the objective of ECGC? ECGC. So very first and foremost objective of ECGC is to encourage and facilitate the globalization of India's trade, to assist exporters in managing their credit risk by providing timely information or worthiness of the buyers, bankers, and the country. The main objectives of ECGC is to provide the to encouraging and facilitate the globalization of the Indian trade. So Indian companies also can move from one place to the other place. They can get certain global exposure in the international market. And apart from this, we have other to assist the Indian exporters in managing their credit risk by providing timely information or worthiness of the buyers, bankers, and the countries. Clear? Further, and the other objective is to protect the Indian exporters against the unforeseen losses. This is I've been already told in a brief starting, because whenever we are doing any international trade or whenever we are doing any export and import business, so there are numerous number of risks are involved. It might have some certain unforeseen losses. To protect the Indian exporters against foreseen losses which may arise due to failure of the buyer. Sometimes buyer doesn't make the payment on time, or sometimes they deny directly that they will not making the payment. Banks are problem faced with the country of the buyers by providing cost affecting credit insurance cover. So there are numerous number of the objectives of ECGC. Further, to facilitate the availability of adequate bank finance to the Indian exporters by providing COT insurance covers for bankers at a competitive rate. Yes, to facilitate the availability of adequate bank finance to the Indian exporters by providing the COT insurance covers for bankers at a very competitive rate, Because ECGC is specialized in an insurance basically for the export and import only, not for domestic business. Please note down this point. Okay. To develop the world-class expertise in credit insurance among the employees, ensure continuous innovation and achieve the highest customer satisfaction by delivering top quality services. To develop the world-class expertise in credit insurance among the employees and ensure continuous innovation and achieve the highest customer satisfaction by delivering the top quality services. So this has wanted to be provide certain world-class expertise in a credit insurance among the employees and ensure continuous innovation through the R&D, research and development, and achieve the highest customer satisfaction by delivering the top quality services. And further, to educate the customers by continuous publicity and effective marketing. To educate the customers by continuous publicity and effective marketing. Now, further, role of ECGC. It provides a range of credit risk insurance. It provides a range of credit risk insurance covered to exporters against losses in export of goods and services. It provides a range of credit risk insurance covers to exporters against losses in export of goods and services. It offers guarantees to bank and financial institutions to enable exporters obtain better facilities from them. It offers guarantees to bank and financial institutions to enable exporters obtain better facilities from them. It also provides overseas investment insurance to Indian companies investing in a joint ventures abroad in the form of equity or loan. Whenever not limited with the export and import businesses, it's limited with the international businesses. Suppose that Indian companies are doing any joint venture with the overseas companies, even though ECGC provide the overseas investment insurance to the Indian companies. Suppose that just like we can take the example of the Hero Honda. Hero belongs to India, Honda belongs to the overseas market. So it's just like if suppose the Indian companies belongs to the, if suppose that company belongs to India, it just want to be make it out any merger or any joint venture, they are entering in the, I've been told in the last slide also, we have a numerous number of the international modes of it. It's just like a export. In every place they are in playing the role of the what we call secure, insurance secure. Exporting, direct exporting, indirect exporting, FDI, merger, acquisition, franchising, licensing, and further that is called joint venture. Any of the modes of business if you are using, even though ECGC providing the overseas investment insurance to the Indian companies investing in a joint venture or in a, through the mergers they are entering in the market, or acquisition or exporting or direct exporting or FDI in the form of equity or loan, they are providing the insurance. Further, economic difficulties or balance of payment problems. Sometimes you have certain current account deficit or capital account deficit, or certain you have problem balance of payment crisis. So economic difficulties or balance of payment problems may lead a country to import restrictions on either import of certain goods or transfer payments for goods import, even though ECGC providing the very vital role. Now, further, what are the functions of ECGC? Functions of ECGC, Export Credit Guarantee Corporation. First, to encourage and facilitate the globalization of India state. Because as we know, numerous number of the risks are involved in international businesses. So if suppose that anyone want to be moved from India to the overseas market, so that during that time, if suppose that if somebody is supporting like a insurer, so it's a very easier for the Indian companies to enter in international market, because that is the thing. ECGC is encouraging the Indian companies and facilitating the globalization. What is all about the globalization? Globalization is all about the integration of the economies. Integration of economies means whole world will come under the single umbrella. So they are encouraging and facilitating the globalization of the Indian trade and provide a range of credit risk. Provide a range of credit risk insurance covered to exporters against loss in export of goods and services due to any unforeseen reasons, due to any reasons. If you are getting any losses, so ECGC providing a range of credit risk insurance. It's covering the exporters against the losses in export of goods and services. It offers guarantee to bank and financial institutions to enable exporters to better facilities from them. They are playing the role of the guarantors also sometimes. It offers the guarantees to bank and financial institutions to enable exporters to better facilities from them. Further, we are moving. It provides the overseas investment insurance. It provides the overseas investment insurance to Indian companies. Provide the overseas investment companies investing in a joint venture abroad in the form of equity alone. This point I've been told in the last slide, so we don't need to discuss again and again. Okay. Now, what is the present scenario of ECGC? ECGC is the 7th largest credit insurer of the world in terms of coverage of national export. It's the 7th largest. It used to be the 5th. Now, as of now, it is the 7th largest credit insurer of the world in terms of coverage of national export. The present paid-up capital of company is 2,500 crore and the authorized capital is 5,000 crore. Please note down this point. Present paid-up capital is 2,500 crore and authorized capital is 5,000 crore. First overseas office of ECGC in London on September 2013. 2013, it has been established the first overseas office in London. Export Credit Guarantee Corporation has achieved a magical milestone of 1,000 crores on premium incomes. An ISO International Standard Organization excelling in credit insurance service, which has 5 regional offices and which has 51 branches across the globe. How does ECGC help the exporters? It offers the insurance protections to exporters against payment risk, provide guidance in export related activities in case of unforeseen reasons, in case of non-payment by the exporters, importers, damages. So it offers the insurance protections to exporters against the payment risk, provide guidance in export related activities. It makes available information on different countries with its own credit rating. It makes it easy to obtain export finance from banks, financial institutions. It assists in exporters in recovering the bad loans. In case of the bad loans, they are assisting the exporters for the recovering. Not bad loans, it's the bad debts. If suppose that importers are not able to make the payment, then ECGCs are assisting the exporters to recovering the bad debts. It's make easy to obtain the export finance from banking financial institution. It provides information on credit worthiness of overseas buyers. Okay. So what are the risks covered by the ECGC? Political risk, commercial risk, LC, letter of credit opening, banking risk. Please take it out the screenshot of this particular slide. But first is political risk, second is commercial risk, and LC opening bank risk. political import restrictions, war, civil war, just like India-Pakistan trade, the border clashes, as we have been numerous number of the border clashes across the globe. So due to the war, civil war, revolutions, and apart from these political interventions, governments are poking their nose in every single matters of export, even though it plays a very, even though ECGC plays a very vital role. Political instability, policies are changing very frequent manner. If the government will be unstable, then it might change the policy in a very frequent manner, even though we have certain political risk. Additional freight or insurance charges, any other causes attributable to importing country. Sometimes due to this, just like after the Pulwama attack, India has put it down certain import restrictions from the Pakistan. So what we can do, political is due to the political risk, government can anytime put it down any restrictions on the import. We will not be import any goods and services from respective country. So, and apart from import restrictions, war, civil war, revolution, additional, suppose that you started putting the additional freight or insurance charges, even though political risk. Secondly, the commerce insolvency of the buyers. Suppose that buyers or importer, if suppose that buyers become the insolvent, then who will be the responsible? During that time, ECGC plays a very vital role. Protected the defaulted of the buyers, a buyer's failure to accept the goods. Sometimes what buyers do, they are not ready to accept the goods, then what you have to do? So buyers failure to accept the goods. LC opening bank risks, insolvency of the LC opening bank. If suppose that importer bank became the insolvent, then who will be the responsible? Because letter of credit is the document which is issued by the importer bank. Letter of credit also used in a methods of the payment also, because due to the LC, we are without taking the payment, we are delivering the goods and services, because letter of credit always issued by the importer's bank, stating that we are taking the guarantees on the behalf of the importer. If something will be happen, then bank will be responsible for same. The thing is that if bank will be insolvent, then who will be the responsible? The insolvency of the letter of credit opening bank, failure of the LC opening bank to make payment due within the specified period. If suppose that in a letter of credit is stating that we will making the payment within the 90 days or 60 days, but they are failed to making the payment on time, even though ECGC plays a very key role. Non-payment or non-acceptance due to the discrepancies in the LC. Suppose that there are certain discrepancies in a letter of credit or non-payment or non-acceptance, so even though ECGC plays a very vital role. Now we will talk about what are the risks which is not covered. Risk of losses due to the commercial or quality dispute. Okay, if suppose that exporters are not sending the goods which is at par the international standard quality, during that time ECGC doesn't cover the risk. So insolvency or default of any agent of the exporters or the collecting bank. In case of, this is the second point, in case of the, if suppose that your agent become the insolvent, so in this condition, risk not covered by the ECGC. Losses or damages to the goods which can be covered by the general insurer, because goods and losses or damages to the goods which can be covered by the general insurance sometimes also. Exchange rate fluctuations, yes. Currency appreciation and currency depreciation. Suppose that $1 is equal to 50 rupees as of now, 50 INR. If it became the $1 equal to 60 or $1 is equal to 40, if suppose it become the $1 is equal to 60 rupees, that's which Indian currency got depreciated as compared to the dollar. If it became the $1 is equal to 40 rupees, that means Indian currency got appreciated with reference to the dollar. We suppose that there will be exchange rate fluctuation, then who will be the responsible? So it might happen, because if suppose that importers are issuing the letter of credit and stating that we will be making the payment after 90 days. So as we know that in every fraction of seconds, exchange rate are changing. So in a 90 days, it might increase, it might appreciate it, it might appreciate it. So ECGC is not responsible to cover this type of risk also. Further, failure of the exporter to fulfill the terms of the contract. I've been told you in a third or fourth lecture, that is called sales of contract. If suppose that failure of the exporters to fulfill the terms of the contract, negligence of his part, even though risk isn't covered by the ECGC. Now, what are the ECGC policy? What are the ECGC policy? Export credit insurance for exporter, special schemes, export credit insurance for banks. Please take it out the screenshot of this particular slide. Export credit insurance for exporters, special schemes, export credit insurance for bank. The schemes, insurance for banks also, insurance for exporters also, and we have some certain special schemes also. Okay. So export credit insurance for exporter. So we have some short-term schemes, we have some short-term, medium and long-term insurance. Shipment comprehensive risk policy. First, small exporter policy, shipment policy, service policy, exporter turnover policy, exporter specific buyer policy, consignment export policy, IT enabled service policy. So we have eight type of the short-term policies. Construction work policy, letter of credit confirmation cover, specific policy for supply contract, specific shipment policy, and specific service policy. So please again take it out the screenshot of this particular slide. Export credit insurance for exporters. We have some short term, we have some long term. Shipment comprehensive risk policy, small exporters policies, shipment policy, service policy, export turnover policy, export specific buyer policy, consignment export policy, IT enabled service policy. Then we will talking about the medium and long term, that is called construction work policy, letter of credit confirmation cover policy, specific policy for supply contract, specific shipment policy, specific service policy. Export credit insurance to the bank. The earlier slide was all about the exporters. Now, what are the insurance available for the bank? Parking credit guarantee. First, export production finance guarantee, post shipment credit guarantee, export performance guarantee, export finance overseas lending guarantee. We will talking about the special scheme, buyer's credit covers, line of credit covers, overseas investment insurance. Overseas, I have been told you about whether you are entering in the business market, in the international market, direct exporting or indirect exporting, FDI, joint venture, merger, acquisition, franchising, or licensing. Whatever the modes of businesses you are choosing, what there are certain options to ensure the overseas investment. Some of the main policies, contract policies, we have contract policy between the two parties. Shipment policies, we have construction work policies, service policies, overseas investment insurance. So we have further 5 policies, some of the main policies: bond, contract policy, bond, shipment policy, construction work policy, service policy, and overseas investment policy. So firstly, we'll discuss about the contract policy. Exporters that have a secured contract for turnkey projects, EPCG, export promotion council contract, or any other contract which involve supplies of capital goods, services for commissioning of the project. They cover, provide protection against non-receipt of payment due to the commercial and political risk covered. Political, legal, and LC opening banking risk that are loss coverage 90%. So exporters that have secured the contract for turnkey project, EPC contract, or any other contract which involve supplies of capital goods and services for commissioning of the project. The cover provide protection against non-receipts of payment due to the commercial or political risk covered, or political, legal, and LC opening bank risk or loss coverage is 90% of total value. What are the obligations? Obtain indicative premium rate at a bid stage. At an initial stage, you have to be make it out certain bid, and you have to put it down certain. You have to be fixes down certain premium rates. Obtain indicative premium rate at a bid stage. Seek cover after payment of premium. Advise progress of project in accordance with the PEM guidelines. Declaration of the overdue payment. If suppose that you are not picking the payment on time, there are certain overdue, even though you have to be gifted certain declarations. Filing of claim within the 12 months from the due date. Sharing of the recovery. Clear? Now, what are the highlights? Cover can be either for political or comprehensive risk, even though ECGCs are covering the risk. Pre-shipment risk cover also can be obtained. Premiums in installment, you can make it out the payment. This is very big thing and very special thing. Premiums in installment, you can make it out. Reduce the premiums for project funded by the multilateral agency. Suppose that multilateral agencies are funding certain project, then premiums is reduced for those companies, those projects. Second is the shipment policies. Exporters that have secured contract for supply of capital goods such as machinery or equipment or deferred terms of payment. So all those exporters that have secured contract for supply of capital goods such as machinery or equipment or deferred terms of payment, the cover provide protection against non-receipt of payment due to the commercial or political risk. The cover provides protection against non-receipt of payment due to the commercial or political risk. Clear? Okay, so exporters, all those exporters that have secured contract for supply of capital goods such as machinery or equipment or deferred terms of payment. If we're talking about the cover provide protection against non-receipt of payment due to the commercial and political risk. In terms of the shipment policy, political and legal and LC opening bank risk also covered. Loss coverage is same, that's just like a same last one, that is again 90%. Obligation in the highlight of the same as mentioned in the previous slides. Clear? So again, I'm just telling you the obligation in the highlights. So what are the obligations? Obligations indicative the premium rate at the bid stage. Seek cover of the premium of the payment of the premium. Advise progress of project in accordance with the PM guidelines. Declaration of the overdue payment. Filing of claim within the 12 months from the due date. Its obligation will remain same. That is the thing I will put it down again. Sharing of recovery. If we will talking about the highlights, cover can be either for political or comprehensive risk. Pre-shipment risk cover also can also be obtained. Premiums in installment, reduce premiums for project funded by multilateral agencies. Third is the service policy. Covers contract under which only service are to be provided. Where when we don't have the physical product, we have only services are there. Covers contract under which only service are to be provided. The covers offer protection to the Indian exporters against payment risks involved in rendering service to the foreign buyers. A wide range of services like technical services or professional services or hiring or leasing can be covered under this policy. So what are the services are included? Technical services is covered the very wide, very good number of the parts. Professional services, hiring services, and leasing can be covered under these policies. Risk covered political, legal, and LC opening banking risk. Loss covered 90%. Obligations and highlights are same in the previous slide. So again, I'm just telling you the obligations. You can take it out the screens out, please. I don't need to tell again and again. Obtain indicative premium rate at a bid stage. Seek cover after payment of premium. Advise progress of project in the accordance with the PM guideline, declaration of the overdue payment, filing of claim within 12 months from due date, sharing of the recovery. Cover can be high, either political comprehensive risk, pre-submit risk also can be covered. Risk cover can also be obtained. Premiums in installment, you can make it out the payment. Reduce premium for project funded by multilateral agencies. You can take it out the screen. So again, I don't need to tell again and again. Construction work policies. It is designed to provide cover to Indian contractor to execute a civil construction job abroad. Whenever the civil engineers or Indian contractors are executing the civil constructions in abroad, this policy is for those work. The cover provides protection against non-receipt of payment due to the commercial or political risk. It doesn't cover the LC because you are already establishing a certain plant there, so you don't require the LC. This covered political and legal risk. Loss covered 85% because earlier everyone was 90%, but this is 85% because it's not covering the LC. LC is not here. Obligations and highlights are the same as mentioned in the previous slide. So again, I'm not telling. Construction work policy, it is designed to provide, it's the same slide. It is designed to provide cover to Indian contractors who execute a civil construction job abroad. The cover provides protection against non-receipt of payment due to the commercial and political risk. It's the same slide I've been put it down. This covered political and legal risk, 85%. Thank you. Thank you so much. Take care.